Chancellor Rachel Reeves is set to launch a formal review and consultation on UK individual savings accounts in the coming weeks. So in this video, I'll present 3 tips for Rachel Reeves's reforms that I think will improve outcomes for you, the investor. This video is sponsored by Lightyear, a UK investment platform with low and transparent fees that offers stocks, funds, and interest on uninvested cash. Now, we don't know precisely what the government's going to announce, but we do have a rough idea. And the venue for the announcement's likely to be the Mansion House speech, which the Chancellor will be giving in July. This is a platform the government often uses to announce its economic priorities and its broad vision for the financial services sector. And of course, the ISA space in the UK is crying out for reform. It's very complicated, there are many different types of ISA, and when you consider things like transfers, limits, I find it complicated myself, and this is my job. But what is clear is that the government's trying to redress the balance between investing in cash, i.e. just hoarding cash, and investing in the stock market. So as part of that, it's quite likely that the cash allowance, that's the amount you can put into your cash ISA every year, which is currently £20,000, that limit is likely to be reduced to maybe maybe £10,000 a year. Another suggestion which has been bandied about is to merge the cash ISA into the stocks and shares ISA. So I'll talk more about that in a moment. But that simplification would be, I think, quite welcome. Now, the reason behind all of this is to focus tax incentives on things which are more productive for the UK economy. So the focus is going to be on stocks and shares and less on hoarding cash, which isn't necessarily good for UK growth. Now, a potential sweetener to make that cash ISA limit reduction more palatable is to increase the personal savings allowance. Now, currently that depends on your tax band, so it's £1,000 a year if you're a basic rate taxpayer, £500 if you're a high rate payer, and £0 if you're an additional rate taxpayer. So maybe those personal savings allowances will be increased. Now, the planned consultation which the government's going to have is with the financial industry. Weirdly, they don't ask investors what they want. So that's the reason behind creating this video, because I've got my own opinion about the top 3 reforms which could help UK investors such as you and I. Now, before I go on and talk about those 3 tips for the Chancellor, today's video is sponsored by Lightyear. My team and I recently visited Lightyear's office in London, and what really stood out was how committed they are to making long-term investing more transparent and accessible. I also got to chat with Vanda, who is leading growth in the UK. We talked about how important security is for investors, as well as growing competition between traditional brokers and modern platforms. Lightyear's goal is to become the leading investment platform, and launching their flexible stocks and shares ISA is a big step in that direction. You can trade ETFs commission-free, although fund manager and a potential 0.35% FX fee apply, and you can trade international stocks for a maximum fee of just £1. They also offer business accounts with the exact same pricing structure, plus all the necessary documents for accounting, a web app, and multi-user access. You can try Lightyear using our special code, PensionCraft, the name of our channel, or follow the link in the description for a chance to win £100 worth of a US fractional share of your choice in your general investment account. Terms and conditions are in the description below. And remember, investing involves risk, and the value of your investments can go down as well as up. So tip number 1, merge cash ISAs. So instead of having a really complex situation where you've got cash ISAs and stocks and shares ISAs, why not just combine those 2 products into one? Now, the government has a point here, which is that a lot of money's been flooding into these cash ISAs. That's kind of understandable given that SONIA, the Sterling Overnight Index average rate, has been high in the UK as the Bank of England fights inflation. But here's a fairly stunning fact. There are 22 million ISA holders in the UK, and just under 2/3 of them only hold a cash ISA. And I think the government's justified in deciding that maybe that's too much of a good thing. Now, at the end of 2023, the value of ISAs in the UK was about £726 billion. of which stocks and shares ISAs made up about 59% and cash ISAs made up about 40%. So that is a lot of cash. Now I know what you're going to say. I like my cash ISA, most people love the product, so why take it away? And there's one primary reason, and it's to do with return. To make that really clear, here's a comparison between something which generates money market returns, which is kind of what you'd get with a cash ISA. And what I'm going to do is compare it with a global equity investment via a fund. And I've chosen both of these funds because they're accumulation funds and they have a lot of history. So this comparison goes back 20 years to 2005. Now just look at the return of the equity investment versus the cash-like investment. There are 9 percentage points difference per year on average. The stock fund is up 600%, whereas the cash-like investment is up only 34%. So if you are going to be putting your money away for a long period of time, I think there's really no question that stocks are going to be the better choice. So for this huge number of people who invest only in cash ISAs, they will be chronically underperforming. Now, I'm not saying you have to put 100% of your investments into stocks, far from it. In fact, if we look at the life strategy funds in the UK and compare that with a money market fund while they've existed since 2011, you can see that if you were willing to take more risk, as you dial up the amount of equity to 100%, you would have done better, but with that greater performance came greater volatility. So Life Strategy 20, which is only 20% invested in stocks, 80% in bonds, had a volatility of about 5%. That's a typical annual percentage price move. Whereas Life Strategy 100 was a roller coaster. Its volatility was about 14%, almost 3 times that of Life Strategy 20. But that's why its returns are higher. If you're willing to take that capital risk, in the long run, you outperform. And I'd argue that for a long-term investment, the actual high-risk investment is going to be the cash-like products like a cash ISA or a money market fund. And I'm always harking back to these base rates, the average long-term returns, but I think it's really important to understand what they are. Now this is backward looking, the future may not resemble the past, but you can see for the row which is labelled bills, which is roughly what you'd get with a money market fund or a cash ISA, the return above inflation is a paltry 0.5% or maybe 0.9% if you're based in the UK. And this is based on historic returns between 1900 and 2022. So that means you underperformed by between 4 percentage points and 6 percentage points per year on average over that period. So you can see that inflation is really important here. And the comparison looks much worse than that if we actually take inflation into account. If we adjust for inflation and we do the same comparison between that global fund and the money market fund, you can see how atrociously the money market fund performed. It fell by 35% in real terms, that's in buying power, whereas the stock fund surged upwards even when we take inflation into account. And if we do the same thing with the Vanguard Life Strategy comparison, you can see that if you really wanted to beat inflation, you needed some equity. So by having a product which forces people to invest only in cash, I think that's going to make the vast majority of people underperform, given the vast number of people who invest only in cash ISAs. So I'm totally behind the idea of simplifying the cash ISA and merging it into a stocks and shares ISA, and maybe rebranding the new product as the cash and investment ISA. Now don't forget that if you did have that product, you could still invest as if it was a cash ISA by buying money market funds. In fact, the rate that you'll get will probably be higher, but the risk of your investment and the return that you receive would be very similar. And that brings me on to tip number 2, which is to do with financial education. Now clearly that's something which is very close to my heart because that's what I do, but I think the government could invest more in educating people in the UK. For example, how many people in the UK actually know those numbers for long-term return for things like cash, bonds and stocks? I'd argue it's very few. Now I bet Rachel Reeves knows because she's got a background in finance. And I bet you know because you watch my videos and I mention those average returns all the time. Even my dog probably knows those returns. Teddy hears me talking about them all the time. He's probably quite sick of it. And yet in school, we're never taught about that. When I left school, I knew lots about things like oxbow lakes. Some of the stuff was useful, like physics, which I loved, but I was never taught about investing. But why aren't these things part of our curriculum? For example, what should we buy? How much of each investment should we combine, given our investment horizon, risk appetite, and of course, risk capacity? What's a money market fund? People wouldn't realize that they can reproduce what a cash ISA does by having a stocks and shares ISA with a money market fund in it. What return should you expect from your investment? Why do fees matter? Why diversify? Why can't I beat the market by buying single stocks? Should I pay extra for active management? All of these questions are never addressed in our education in the UK, and I think they should be. But it's not just about educating kids about investment. I think adults should be educated as well. Now, you may remember these ads from the 1980s when lots of people got into the stock market because of these ads. They were the famous Tell Sid ads, which were quite effective.
Yes, lass. Garibaldi's, please. These British Gas shares. Did you know they'll be publishing the prospectus on November the 25th?
I didn't.
If you want to apply, you can reserve one over the phone. If you see Sid, tell him, will you?
So why can't the government do something similar now to do with their reforms for ISAs? Explain why you're doing what you're doing and the benefits of an ISA, which I think is an incredible gift. My final tip is to do with forcing people to buy UK stocks. Now, for institutional investors who run pension money, if you look at their overall allocation to UK stocks, depending on the type of pension, it is very low. For pensions overall, it's around 6% invested in UK equity. 30 or 40 years ago, that was much higher. But this isn't about pensions, it's about ISAs, and many of us manage those ourselves. And the reason why we manage them is to get the best possible returns. Now, I'd argue that by forcing people to invest just in the UK, it actually increases the risk, and let's be honest, it's going to reduce our long-term return. And that runs contrary to the whole purpose of having stocks and shares ISAs in the first place. So while the pensions fund industry can push back on suggestions because they have a lot of heft as an industry, for us it's much more difficult as retail investors to say no, that's not fair and it's going to disadvantage my future returns. So I'd say hands off the ISAs when it comes to forcing us to buy certain things like UK equity. Now, I can see why the government wants to induce pension funds to put more money into the UK market. It is more likely to stimulate UK growth if they have a greater allocation to UK stocks. If you're a bit woolly about the mechanism for that, well, it's to do with the cost of capital. If there's a greater demand for UK stocks, that tends to push up their prices. In return, that creates a kind of halo effect where people expect better returns in future and they think there's less risk in the stocks which have gone up in price. That in turn pushes down something called the equity risk premium. And when you look at pricing models for stocks, that reduces something called the weighted average cost of capital. Now that's all a bit theoretical, but I think the key point is that it's cheaper for companies to raise capital to grow because they can do that in the equity market, and they're less dependent on debt to grow. It also means they can issue new shares at a higher price, and that means their existing shareholders will get less dilution for a fixed amount of capital raised. So shareholders will be happier and the companies can grow by raising capital in a thriving equity market. Now, the pensions fund industry has a lot of heft. It's a very large industry and politicians listen to what they say. Whereas retail investors such as you and I, we don't really have a voice at the table. So that's why I think it's not fair to force UK ISA investors to buy UK stocks, because let's be honest, it's likely to reduce long-term return. And compared to investing in global equity, you can see here in this graph of MSCI UK, which is a UK equity index, versus MSCI World, how much the UK has underperformed over the period since 2010. In case you were wondering, the dark blue line at the bottom of the graph is the UK. And a large proportion of that outperformance has come from the US. Now, if we go all the way back to 1994, the outperformance isn't as marked. It's only about 1 percentage point on average per year, but it's an underperformance nonetheless. Plus, if you force people to buy UK stocks, they're forced to buy a weird sector composition. The UK is notable in that it has almost no tech in it at all. Instead, it has lots of consumer staples companies. And it's not just about return. I'd argue that the UK is more risky because it's a very concentrated stock market. Everyone talks about concentration in the Magnificent Seven in the US, but the top 10 stocks in MSCI UK make up half of the overall index. And if you look at the overall size of the UK market, in sterling terms, it's about £2.3 trillion. This MSCI UK index only captures about 85% of the UK market cap. Compare that with the United States, and just one stock is larger than our entire stock market in the UK. Apple's market capitalisation is £2.4 trillion versus the UK's entire £2.3 trillion. So while I think some UK ISA reforms are long overdue, and I think simplification is probably the most important one, I also think it's important to educate people about how to invest. ISAs are a wonderful thing, but many people just don't realise the benefits of long-term return combined with not paying capital gains tax. But I really would push back if the government wanted to force us to buy only UK stocks or a fixed amount of UK stocks. That would make the outcome, both in terms of risk and return, worse for investors in the UK. But tell me what you think in the comments below, because after all, this is going to affect you. Now don't forget the special offer from the sponsor of today's video, which is Lightyear. You can use the special code PensionCraft, the name of our channel, or follow the link in the description below for a chance to win £100 worth of a US fractional share of your choice, and that'll go into your general investment account. Terms and conditions for that offer will also be in the description below. And of course, remember that investing involves risk, and the value of your investments can go down as well as up. And, as always, thank you for listening.